Stop doom scrolling, because what you're watching right now is the exact moment a ton of investors get baited into selling the best part of a move right before the next leg higher. Gold just ripped, then snapped back hard. Silver did the same. And if you're feeling that gut punch like, wait, is this the top? Stay with me, because the answer isn't as simple as the chart makes it look. This is one of those weeks where the market pulls a magic trick on purpose. And I'm telling you up front, the sell-off you're seeing can be totally real while still leading you to the wrong conclusion. Now, quick thing, and I'll keep it short. I'm running a campaign to eliminate copycat channels that recycle other people's work. If you value what we do here on Chill Guy, support it by subscribing and dropping a comment so the platform knows you're backing the original voice. All right, here's what happened. We rolled into the final stretch of January, trading with metals, acting like they had jet fuel. Big spikes, big headlines, big emotion. Then, right as the calendar flipped into delivery season for the front month contracts on the main US futures exchange, the market slammed the brakes. In 2 days, you got one of those violent up-then-down sequences that makes people question everything they believed just 48 hours earlier. But here's what most people miss. The market doesn't only move on truth. It moves on positioning. It moves on who's trapped. It moves on who needs to unwind. And it moves on the clock. Time matters more than most people want to admit. And in a minute, I'm going to prove that with 2 simple historical patterns that investors still refuse to learn from. But before that, I want to lock this moment in because it matters. I'm recording this on Saturday, January 31st at 9:40 in the morning, New York time. Drop a comment with what time you're watching right now, because I'm always curious how global this community really is. Now, let's talk about why prices can drop hard without the bigger trend being dead. When you get a fast run-up, you attract a very specific type of buyer. Not the long-term stacker, not the industrial user, not the person building a hedge for the next decade. You attract the momentum crowd, the I'll buy it because it's going up crowd, the I saw it on a chart crowd. And that crowd has zero patience. So, when the move pauses, they don't ask, is the thesis still true? They ask, can I still lock a profit? Then they smash the sell button. That's profit taking. It's not a moral issue. It's not even a bearish forecast. It's just what happens when a trade gets crowded. And profit taking can look like the end of the world when you're staring at a one-day candle. But zoom out even a little, and the story changes. Now let me hit you with the first history lesson. Back in the late 1980s and throughout the 1990s, gold basically lived inside a boring box. It bounced between the low 300s and the upper 300s. Not because nothing mattered, but because the market got stuck in a rhythm. Traders who understood that rhythm made money over and over. Buy the bottom of the box, sell the top. Then the box broke. In the late 90s, gold slipped under the floor. And once it fell through, it stayed down for years. Here's the key point. People who only understood fair value kept screaming that it was too cheap, and long-term, they were right. But the short run lasted a long time. And that's the part that hurts, because the market can stay wrong for years while still behaving perfectly normal. And if you don't respect that reality, you get shaken out at the worst moment. Now the second history lesson. In the early 2010s, after that famous peak era in commodities, a lot of markets went into a cyclical decline. Not because the secular story died, not because the world stopped needing metals, but because money rotated, leverage got cleaned out, and the cycle took a breath. That decline lasted years. Then the secular trend came back. So the takeaway isn't it only goes up. The takeaway is a trend can be bullish and still have brutal stretches. And once you understand that the current pullback stops looking like a funeral and starts looking like a shakeout. Now here's the cliffhanger. This pullback wasn't just emotional. It had mechanical fuel. And once you understand that fuel, you'll understand why it can reverse fast, possibly faster than the crowd expects. Let's go there. The front month contract was heading into delivery. That matters because delivery periods force decisions. Shorts have to roll their positions forward or prepare to settle up. Longs have to decide whether they're taking delivery, closing, or rolling. And that rolling process can create huge bursts of buying or selling that have nothing to do with your aunt's opinion of inflation. So what happens? Shorts buy back the expiring month, then sell a later month. That's a rule. And when a lot of shorts do it at once, it can send prices screaming higher. Then once that wave passes, the price can drop simply because the urgent buying is done. That doesn't mean the bull market ended. It means the calendar event ended. To make that concrete, think of it like a stadium crowd. If 10,000 people rush through the same gate at the same time, it feels like a stampede. But once they're inside, the pressure disappears. The stadium didn't collapse. The gate just isn't crowded anymore. That's what rolling pressure looks like. Now some people hear delivery and imagine trucks backing up to a vault like it's a movie. That's not how most of this works. A lot of what gets called delivery is really a transfer of claims inside the system. Paper changes hands. Warrants change hands. The metal might not move an inch. That's why a delivery window can create fireworks in price, even if the physical world looks calm. And here's the irony. The physical market can be tight, while the paper market looks liquid. But here's the danger. When the paper world gets too confident, it stops respecting the limits of the physical world. That's when you get those sudden spikes, where nobody can explain why price moved in 10 minutes. So when you saw that front month high print, part of that was the market realizing, oh, a lot of people promised something, and now the calendar is asking for proof. Then once notices start going out, another weird thing happens. Some longs don't want the hassle of staying involved. Some shorts don't want to be on the hook, so the same bars of metal can get delivered, then resold, then delivered again on paper. It's like passing the same hot potato across a table until someone finally decides to hold it. That's why you can see big delivery notice numbers early in the month, and then watch a bunch of it get effectively recycled as the month goes on. It's not a conspiracy. It's the mechanics of a financialized market. If that sounds complicated, good. It is. And complexity is where most people get tricked because they simplify everything into one lazy sentence. Price fell, so the story is over. That's the lazy conclusion. Here's the smarter way to think about it. When forced rolling ends, you're left with the organic bid. The organic bid is the buyer who steps in because they want exposure, not because the calendar forced them. That bid doesn't always show up instantly, but when it does, it can feel like the market suddenly turns on a dime. So, what do we watch to see if the organic bid is returning? 1. Do dips get bought quickly, or do they bleed all day? 2. Do the next month contracts stay supported, or does the whole curve collapse? 3. What's the physical market doing? Premiums, wholesalers, coin dealer backlogs. And 4. What's the vibe in risk assets? Because when equities wobble, the bid for protection tends to wake up. Now, here's the cliffhanger I promised. The market can bounce even while the headlines stay scary. Because a bounce can be driven by nothing more than this. The sellers are done. And once the sellers are done, the next buyer doesn't need a reason. The next buyer just needs a price. That's why these moments matter. Because if you blink, you miss the turn. And if you were watching those intraday highs recently, you saw that stampede in real time. Prices printed fresh records on the front month, then gave back a chunk. People called it panic, but a big chunk of it was simply positioning. Here's where it gets spicy. When open interest in the front month collapses, it tells you a huge part of the market already made its choice. The roll happened. The urgent buying is behind us, so the price can sag. But what happens next depends on who's still left. If it's only weak hands left, the drop continues. If it's strong hands stepping in, the drop becomes a springboard. And right now, there are signs we're seeing more of the second than the first, because the bigger forces that push people into medals didn't magically vanish in 2 sessions. They're still here. Now let's talk about the political whiplash, because it matters, just not in the simplistic way people think. We just watched lawmakers flirt with a shutdown scenario, then step back at the last second. Markets love crisis averted for about 5 minutes. Then they realize what it usually means. Delays, patches, and more spending later. That short-term relief rally is real, but it's also shallow because the incentives underneath don't change. At the same time, we've got drama around leadership at the US Central Bank. Even the rumor of a leadership change can shake expectations because traders start pricing in a different reaction function. Will policy stay tight? Will it get politicized? Will it prioritize markets over purchasing power? Those aren't academic questions. They change how big money positions. And here's my skeptical take. People act like a single appointment restores credibility. It doesn't. Credibility is earned over years and lost in weeks. Markets, remember, if the street senses policy is becoming a tool, risk premiums don't shrink, they grow. So, when you saw the currency bounce on things calming down, understand what you were really seeing. Traders unwinding a crowded bet, not the world suddenly becoming stable. And if you're thinking, okay, but what about war risk? Yeah, that's still hanging in the air. When you hear talk of deployments, threats, and chest thumping, you don't need to be a geopolitical expert to understand the basic investor reaction. Protect the downside. That's why gold, jewelry, demand, and small bar buying tends to rise in regions that feel exposed. People hedge first, then ask questions later. So, if someone tells you, relax, it's all solved, ask them one question: solved for how long? Because markets don't price forever. They price the next surprise. And right now, surprise risk is still high. We still have political risk. We still have policy uncertainty. We still have headlines that can flip mood in one press conference. And we still have the quiet, slow-burning problem that never trends on social media: debt and currency debasement. Now, before I go deeper, quick reminder, check the description. I've dropped bonus links down there, including a premium WhatsApp channel link and a channel membership join link for people who want the updates and deeper dives without hunting around. All right, back to the plot. Over the last couple days, we saw risk on relief and risk off fear fighting each other. On one hand, some political drama cooled down temporarily, so some panic premium came out. On the other hand, international tension didn't vanish, so demand still had a floor. And here's the part nobody loud in finance wants to admit. The same headline can be read two different ways. A last-minute deal can spark relief or signal the system is kicking the can again. And when the system kicks the can, the long-term consequence is usually more spending, more borrowing, more pressure on purchasing power. So you might see a short-term bounce in the currency and a short-term dip in metals. Then, as people digest what actually happened, the longer-term bid comes right back. That's why I keep saying, don't confuse a fast reaction with a final verdict. Now let's talk about the currency for a second, because this matters. When the dollar ticks higher for a day or two, people sprint out and declare victory. Strong dollar, weak gold. That's headline-level thinking. The deeper view is this: currencies can bounce and still be in a broader downtrend. And if you measure the currency against what matters in real life, energy, food, housing, and hard assets, those bounces often don't change the trend at all. From recent market updates, the dollar has been in a choppy phase. It can fall for a stretch, snap back on a political headline, then drift again. That chop is exactly the environment where metals whip around and punish anyone who's over-levered. Which brings me to a question for you. Are you watching this as a trader or as an investor? Because if you're trading, volatility will eat your lunch if your timing is off. But if you're investing, volatility is often what hands you the discount. And I want you to hear this next part carefully. Even if gold pulled back more from here, it can still be rising on the larger chart. Same for silver. That's not a prediction. That's just math. If you draw a trend line from last year's lows through the major consolidations, you can build a scenario where prices dip hard and still stay inside a bull structure. That's why people screaming it's over after a sharp drop are usually telling you more about their time horizon than the market. Now, let's shift into silver, because silver is where the drama always gets extra. Silver deserves its own spotlight because silver is the metal that embarrasses confident people. Silver is half money, half industrial input, and 100% mood swing. When the market is excited, silver outperforms because it's smaller and easier to push. When the market is scared, silver underperforms because it's smaller and easier to dump. That's why a drop in silver can look terrifying even when the longer-term setup is still constructive. Here's context you don't hear enough. A growing chunk of silver demand comes from industries that do not care about your screen price today. Solar manufacturing is a big one. Electrification is another. Data centers, medical applications, power grids, high-end electronics, all of it leans on silver's conductivity. Yes, engineers can thrift and substitute sometimes, but there are limits before performance and reliability suffer. And supply isn't a turn the faucet story either. A lot of silver is produced as a byproduct of mining other metals. So, silver supply can't always respond quickly to higher prices because it depends on what's happening in copper, lead, and zinc markets. That's how tightness builds quietly. Demand rises. Supply reacts slowly. Now, stack the investor layer on top. When the crowd piles into silver, it shows up in the easiest vehicles first. When the crowd exits, the same thing happens in reverse. Then the physical market has to digest that flow. That's why you'll sometimes see headlines about ETF outflows at the exact moment your local physical market still feels tight. 2 layers, 2 realities. So, if you're watching silver and thinking, maybe I should just avoid it, that might be rational for a short-term trader. But for a longer-term investor, the volatility is part of the opportunity. It's the price you pay for owning something that can re-prick violently when the world gets nervous. Now, quick question. Are you more bullish on gold or silver from here? And why? I want the reasoning, not a one-word answer. Silver doesn't walk. Silver sprints, then trips, then sprints again. And what's happening under the surface in silver is exactly why I'm not buying the "this is the end" narrative. The next active delivery period for silver is still ahead, which means positioning pressure hasn't fully played out yet. And silver open interest, how many contracts are still in play, has stayed heavy enough to keep the market sensitive. That sensitivity is a curse if you're on margin. But it's a gift if you understand what it means. It means the market is still alive. Now, let's talk about the elephant nobody wants to touch. ETF flows. A lot of retail treats ETFs like a scoreboard. If ETFs are bleeding, they assume the story is bearish. If ETFs are inflating, they assume it's bullish. That's an oversimplification. ETFs are a vehicle. They reflect behavior, not truth. In a fast rally, people pile into ETFs because it's easy. In a pullback, some of those people sell to lock profits. That selling can temporarily push prices down, not because fundamentals changed, but because the easiest vehicle is also the easiest exit. And when that selling hits the system, you can get a backlog in the physical supply chain. Dealers, refiners, wholesalers, because metal that was sitting in investor form is suddenly being converted, shipped, or reprocessed. It's messy. That mess can create short-term softness in price, but it can also set up the next squeeze because the physical world doesn't adjust instantly. Here's the cliffhanger. The people who sell during that messy phase often buy back later at higher prices because they confuse volatility with validation. And the market loves punishing that mistake. Now you might be thinking, okay, John, but if this is just profit-taking, why did it hit not only gold and silver, but also copper, aluminum, and the rest? Good question, because when a big macro trade gets crowded, the unwind doesn't politely target one asset. It hits a basket. Multi-asset funds don't always sell one thing. They de-risk across the board. They trim what's up. They cut what's volatile. They raise cash. That's why you can see base metals slide at the same time precious metals slide, even if the stories are different. Now, let's go deeper, because this is where the competitor-style narrative usually ends and where we're going to add real value. Based on recently published numbers, silver's demand profile is shifting more and more toward industrial use. Solar panels, electronics, electrification, grid upgrades, these all use silver in ways that are hard to replace without performance losses. That doesn't mean price can't pull back. It means the longer-term floor is supported by a buyer that does not care about your chart pattern. And here's the twist. Industrial demand doesn't show up like a viral headline. It shows up like a slow squeeze. A slow squeeze that makes pullbacks feel safe until they aren't. Gold has its own version of that. It's the ultimate balance sheet asset. It's what people lean on when they don't trust paper promises. And whether you love or hate the political situation, we're in an era where institutions and individuals have more reasons than ever to diversify away from purely financial claims. Now, I want to challenge one point that always gets thrown around during sell-offs. If this was a real bull market, it wouldn't drop like this. That's nonsense. Real bull markets drop like this all the time. In fact, the strongest bull markets often have the most violent pullbacks because they attract leverage. When leverage gets rinsed, you get a drop that feels personal. So, the question isn't, did it drop? The question is, who got forced out? And if the forced selling was mostly short-term players, that's not bearish, that's cleaning. Now, another angle that matters, inflation data. Traders treat inflation prints like a green or red light. Hot inflation, buy metals, cooling inflation, sell metals. But metals respond to real rates and credibility. If people believe policy will stay tight and credible, that can pressure metals. If people believe policy will bend, wobble, or fail to keep up with price levels, that supports metals. And the latest inflation updates have been mixed. Goods prices can cool, while services stay hot. That's classic. It's also why policymakers get trapped. You can't easily crush services inflation without damaging the labor market. So, you end up in this weird world where headline inflation can look fine, but the stuff people feel every day keeps climbing. And when that gap grows, people look for a hedge that doesn't require permission. Now, let's pivot into the longer-term bond question, because this is where the macro story gets spicy. People love to ask, what happens if foreign buyers stop financing US debt? It's scary. Fear sells, and that's why you hear it non-stop. But the reality is more nuanced. First, demand for government debt doesn't always vanish in crisis. Often, it increases because big capital chases perceived safety. Second, not all foreign holdings are foreign the way people assume. A meaningful chunk can be domestic money held offshore through structures. The labels aren't as clean as headlines suggest. Third, domestic institutions are huge buyers. Retirement systems, banks, insurance companies, money market vehicles, because regulations and mandates push them there. That's not ideology, that's plumbing. And finally, the central bank exists. If the system ever hit a true no-bid moment, the central bank can step in as buyer of last resort. That doesn't mean it's good. It means the system has a backstop. And here's the cliffhanger. That backstop is one reason hard assets matter, because the backstop often involves creating more currency units. So even if auctions get covered, the deeper question is, what does that coverage cost you in purchasing power over time? Here's the psychological trap. When people hear bid to cover ratio or strong auction demand, they assume it means the currency is strong. But an auction can be successful while purchasing power still erodes. Two different conversations. One is market mechanics, the other is living standards. So, if you're stacking metals thinking in decades, short-term auction chatter isn't the whole story. Now, let's get practical again. What should you expect next? Here's my base case, and I'm going to phrase this carefully because nobody controls the market. I wouldn't be shocked if we see a rebound attempt as soon as the next trading week. Not because the market owes us, but because the forced buying and forced selling that created the whiplash is already cooling and the demand drivers are still on the table. But even if we bounce, I also wouldn't be shocked if the market enters a messy plateau later in Q1 or mid-year, where it chops and frustrates everyone. That chop is where weak hands quit, and that's where the next move tends to get built. So if your plan requires every week to be green, you're going to hate this environment. But if your plan is built around building a position through volatility, this is exactly where patience can actually pay. Now let's address the price level obsession, because this is where people get lost. Yes, prices can fall a long way and still be bullish on bigger structure. True, but that doesn't mean you ignore risk. It means you respect the difference between a pullback and a collapse. A pullback is a retracement that cleans leverage. A collapse is a fundamental break. Right now, the evidence points more toward cleaning than breaking. And the reason I say that is simple. From publicly available positioning data, the market recently had a crowded front-month exposure that almost always leads to a shakeout. Those positions have been reduced. That's the market exhaling. If this were a collapse, you'd likely see different signals. Sustained selling across multiple weeks, breakdowns in physical premiums, and a broad loss of interest. We're not there. Now, I'm going to ask you something, and I want a real answer in the comments. Do you think this pullback is shaking out traders? Or is it changing your long-term view? And while you're there, if you've been doing well, share your success story in the comments. People underestimate how much one real story can help someone else hold through the noise. All right, quick detour into platinum and palladium because these metals matter and they get ignored. When markets de-risk, these can get hit harder because they're thinner and more volatile. They're also tied to industrial cycles and automotive trends, which adds extra layers. But the long-term story there has its own twist. The world is shifting technologies. Supply chains are tight in pockets. Substitution isn't always easy or immediate, so those markets can swing violently. If you're watching them, understand this. A big drop doesn't automatically mean the thesis is dead. It often means liquidity is thin and positions are getting cleaned. Now, I can't leave without touching geopolitics because it's part of the current bid. When investors get even a whiff of a wider conflict, especially in energy-sensitive regions, they start thinking about second-order effects, oil prices, shipping, supply disruptions, and how governments respond. And how do governments usually respond to shocks? They spend, they subsidize, they borrow, they promise stability. Those promises can calm markets short-term, but long-term they often increase the amount of currency chasing the same set of real goods. That's why, even if a headline cools off for a weekend, the longer-term reason people hold metals doesn't evaporate. Now, I'll give you one last loop to keep you watching, because this is the part that catches people off guard. If the market snaps back quickly, the same people who sold in panic will rush to buy again because they don't want to miss out. That creates a chase. And a chase can recreate the very crowding that caused the pullback in the first place, so the next move can be strong and then messy again. That's why strategy matters more than emotion, and that's also why we have members-only videos. We've got a separate team that goes deeper with more research and more charts, only for premium members. If you want higher signal content without the noise, check the membership join link in the description. Now, I want to wrap this with a simple mental model. Two games are happening at the same time. Game 1 is the short-term game. Contracts rolling, traders taking profits, headlines popping, the dollar bouncing, the market trying to shake you. So, here's what I want you to do after this video. First, decide what game you're playing. Second, if you're building long-term exposure, stop letting one-day candles bully you. Third, if you're trading, size your risk like the market is out to embarrass you, because it is. And lastly, keep learning, because the market is not going to get kinder. One more question for the comments. What do you think is the biggest driver over the next few months? Currency moves, rate expectations, or geopolitical risk? And again, if you're successful, share your success story in the comments so others can stay motivated. That's how we build a community that actually wins. Alright, I'm going to land the plane. This pullback looks like a classic mix of profit taking a king and calendar mechanics after a fast run, not a sudden death of the bigger trend. Could it go lower? Sure, markets can always go lower, but the reasons people were buying in the first place haven't been resolved. They've just been temporarily overshadowed by a positioning unwind. So, don't get hypnotized by the drama. Get disciplined. So, don't get hypnotized by the drama. Get disciplined. And don't forget to check the bonus links in the description, including the premium WhatsApp channel link and the channel membership join link. If you haven't subscribed yet, do it now, because you're going to want the next update when the market shows its next card. And as always, take care of yourself, take care of the people around you, and I'll see you in the next one. And just to be crystal clear, nothing I said here is personal financial advice. I'm sharing educational commentary and my own analysis so you can think for yourself, check the facts, and make decisions that fit your situation and your risk tolerance.